Hello friends, welcome to the Whale Pulse channel. On this channel, we dive into daily analysis and signals in the crypto world. So, if you want to stay one step ahead, make sure to subscribe and hit the notification bell. In this video, I want to teach you about capital management and risk management, so stick around until the end and stay with us. You might be wondering, what does capital management even mean? Or maybe you're already familiar with this concept, but don't use it, thinking it hinders your progress. Capital management means managing your capital in a way that each loss only costs you a small portion of your total funds, so that a single win can cover several losses and still leave you in profit. This ensures that you never lose all your money and helps you maintain the most important rule in trading: surviving in the market. Now, let's talk about the capital management formula. Your total capital multiplied by the amount of loss you're willing to take per trade, then multiplied by leverage, and then the stop loss. The amount you're willing to risk per trade is about how much of your capital you can afford to lose without losing your temper, being unfair to your family, or blaming yourself. You need to assess this based on your personal situation. For example, I personally risk 1% of my capital per trade because I know if I risk more than that, I can't control myself. Next, think about it. If you lose 1% of your capital for 4 consecutive days, would that bother you? Based on these factors, you need to figure out what percentage works for you. My suggestion is not to risk more than 3% of your capital because it might get too difficult. For example, if you have $100 and want to risk 1% per trade, with a leverage of 10 and your stop loss is 2%, we can calculate that to risk 1% of your capital, you should open a position with $5. Now let's move on to the concept of risk to reward, AR to R. Let me give you a daily life example. When someone suggests buying something, and they tell you there's a 60% chance you'll lose, but a 40% chance of making a profit, would you go for it? Probably not. So, in trading, the risk-to-reward ratio should work in such a way that your potential reward is higher than your risk, making the trade worthwhile. Your target, where you want to close your position, should be at least twice the amount of your stop loss in order for it to be worthwhile and for you to recover from 2 losses with a single win. So, what's the minimum risk-to-reward ratio? At least 2 to 1. When we trade with a risk-to-reward ratio of 1, it means there's a 50% chance of losing and a 50% chance of winning. So, hitting the target once and hitting the stop loss once will break even. But when we follow a risk-to-reward ratio of 2, we can hit our stop loss 65% of the time and our target 35% of the time, and still break even. This gives us more room for error. We can lose 6 trades and win only 4, and still come out even. That's a great edge to have in trading. For example, here's a position where we set our stop loss at 1%, so our target should be at least 2%. I explained this tool in the previous video. The next concept is risk management. Risk management means setting your daily risk in a way that ensures you never lose more than a certain percentage in a single day. This means setting a daily risk limit. For example, we might decide to risk 3% of our capital per day, and for each position, the maximum loss allowed is 1% of our capital. This means we can open up to 3 positions a day, and once we hit that limit, we don't open any more positions for the day. It's crucial to control your position opening and stick to your daily limit. This is tough, but it's very important. Here are some examples to help solidify the concept of capital management. Person 1 has $1,000 and risks 50% per position, which is $500. If they open a position without a stop loss and get liquidated, they lose the entire $500, meaning they lost half their capital in one trade. Person 2 has $1,000 and risks only 2% of their capital per position, which is $20. We assume the person doesn't use a stop-loss, but they should, as it's one of the most important factors for surviving in trading. If they lose all their capital in the position, the remaining amount will be $980. Following capital management, they risk 2% again, which is $20. Now, with the risk-to-reward concept, they open a position with a 3-to-1 ratio and make a $60 profit, recovering those two losses and making a $20 profit. This is the concept of everything I've talked about. If someone understands risk management and wants to risk 3% per day, they shouldn't open any more positions once they've hit that limit. I hope this video was helpful to you. If you want to learn more about technical analysis, make sure to subscribe and hit the bell so you get notified when we upload a new video. And if you want free signals and daily hot coin recommendations, you can join our Telegram and Discord channels and follow us on Instagram. Thanks for watching.